The Money Show.
Personal Finance with Warren Ingram.
Welcome to the Money Show this evening, and the Personal Finance brought to you by Toyota Financial Services. Toyota Financial Services is an authorized FSP and registered credit provider. T's and C's apply. Before we get into the meat and potatoes this evening, we've asked for questions and people emailed them through, and I get questions through and people WhatsApp the questions. Santosh has got a good one on gold, and the reason why people put gold in portfolios, making the point that gold is seen as a crisis hedge, but it's remained largely flat through COVID, American inflation, Russia-Ukraine war, when you would have actually expected in a time of crisis an exponential increase in the gold price. So there's a quick calculation of the annualized growth in gold since 2002, so this is 20 years, is just under 10%, which is only a little bit higher than inflation, definitely higher than if one invested in US dollars in the S&P 500. But the question is, this is very confusing. Between the volatile rand, local corruption, US dollar or gold, where does one invest? Because gold has not outperformed, has not behaved in the way that a textbook gold bull will tell you. He says, should gold still be included as a portion to allocate investment funds, or do we leave it as a payment mechanism which governments use to trade by moving gold bars between vaults at Fort Knox? I think it's a good question for us this evening. Warren Ingram.
Fabulous question, and I think a lot of people are asking themselves a version of this is, we've seen this, this hedge against uncertainty and often a hedge against inflation, and now we've got major uncertainty, major inflation, and then this, the kind of cure for all evil, and it's not doing anything. But I do think it's important to understand context. I think a lot of people have been buying gold for quite some time, pretty much, let's say, from about 2010 onwards, because they were really worried about inflation after the financial crisis, when central banks started to support markets through very low interest rates. And a lot of, serious commentators were saying that that's going to be very inflationary. They've only been proved right now, kind of a decade or 12 years later. But I think a lot of people have been buying gold for quite some time already. So it's a very unusual 10, 20-year period to be looking at, and not suggesting that, Santosh chose that period specifically. I think 20 years is a reasonable time to look at an asset's performance. But I think there is a huge context to gold, and it's been rather high for quite some time. When I grew up in the gold markets, you would look at gold at 800, and now on his graph it's 1,700. So it's all about time frames in gold. The short answer to the long question, though, is I would probably avoid gold as a suggestion for most investors, because it doesn't generate interest, it doesn't generate dividends, doesn't generate rent. So while you hold it, it kind of just sits in a vault somewhere, or as a line item on a screen for you, and does nothing until such time as people start to feel it adds value again, and then it usually shoots up in a very short space of time, and everyone gets excited, and then you need to be really quick to sell it. Alternatively, you hold it and it collapses in price, and then you end up being forced to hold it for a very long period of time until the world gets fearful again. So for me, it doesn't really play a great role for most of us, investors. Where it can play a role is more around, I think, very wealthy people, and I'm talking about, people with wealth that goes to sort of 2-3 generations. And you'll find a lot of those families might end up holding 5 or maybe at a huge amount, 10% in physical commodities like gold and silver and platinum and the like. And that's really there as the ultimate insurance policy against the collapse of the financial system, something much bigger than what we've been through now.
And that's
I think
where people get hooked up on this thing and get excited is because I'm not going to buy Bitcoin because that's cryptocurrency. I'm not going to do that, but I'm going to hold gold because then I'll be able to buy food when everyone else is marauding in the streets. And it's okay. So once we get to that sort of level of dysfunction in society, things are going to go pear-shaped really quite quickly. And you're going to have an awful lot of gold to have a viable survival option, I suspect.
I think it's exactly right. And I think, there might be times, for example, where an entire, society collapses. I mean, we can see that, if you look at Zim, when farms started being taken, families that had access to gold coins that they could move, they might be very grateful for a decision like that. But it's extremely rare cases where that's going to apply. And my sense of something like that is, if that's starting to happen, to physically move the kind of gold around is going to be very difficult. So I think, Bruce, it's one of those things. There are people that are absolutely passionate about gold, and every decade or two they get proved right, and they crow about their success. For the rest of the time, if you want to hedge against uncertainty and volatility and all of those things, then kind of sticking to a proper diversification strategy where you own a range of assets, whether it be cash, property companies, normal companies, government bonds, local, global, and really spread them as far and as wide as you can. That's inevitably going to be a good strategy for you over a long period of time. It doesn't mean that all of those things won't go down over a short period of time. I think the first 6 months of this year, a lot of people started to question the value of diversification, but over the last 5 months, they see the benefit again. So to me, Santosh, I would go for lots of diversification if you want to hedge yourself against, big uncertainty. But gold, I'm not convinced. I certainly wouldn't be buying it and stocking my Christmas stocking for myself or my wife with gold.
If you do have someone you do need to stock a Christmas stocking, I'll volunteer. Honestly, it's fine. I'll take it. I mean, not something I would choose and pay for, but if you're giving it away, I wouldn't want you to have any financial regrets. I want you to feel like you've done some good in this world, Warren. Let's talk about those financial regrets, because that's a nice segue. And I think we all sort of look at could have, should have, would have. We should have done this. We should have started sooner. We should have bought different stuff. We should have been more courageous. We should have been less frightened of the future. We should have, and we kind of then almost talk ourselves into a stupor of stupidity as a result of our failure to do things or the choices we made. How do we get over this sort of stuff? What's the context of your thinking around this?
I think the context is looking at this massive blow up in the US of a collection of companies, broadly under the FTX kind of name. And it's a very complicated structure. There are, I think at last count, something like 180 companies involved in the structure. But essentially, let's just say a crypto exchange to try and really dumb it down for people like me to understand.
We have been in the last half hour. Simon Diggle has been telling us all about it. So I think a couple of people may have joined us since then. But you can whiz over this fairly quickly, I think, Warren. Just in terms of we've got the context and the understanding of the basics of the fraud that is manifested and playing itself out.
So what we see, and maybe for me, the context then is looking at, people at the age of 25, 30, 35, suddenly going from zero to a wealth of $25-30 billion. And we see these sort of new titans of the world, strutting their stuff on the global stage, being invited to very big conferences where they're, talking about the future of finance and sponsoring sports stadiums, etc. And we sit in our day-to-day lives looking at these people and maybe looking at our neighbors who might have, followed them, followed these titans. And we realize we know for a fact that we're smarter than our neighbors, but our neighbors are telling us that they're suddenly worth multiples of millions more than they were 6 months ago. And we sit with this massive regret of, why didn't we jump on the bandwagon? If Fred next door is not that bright, and I know that for a fact, and I feel like I'm a little bit brighter than Fred, why did I miss out? Why am I still missing out? Why am I not jumping on the bandwagon? And that sort of psychology forms a momentum of its own. And it certainly struck South Africa. It struck globally. And the reality is people start climbing onto this investment bandwagon. This time around, it happens to be the crypto space, but next time around, who knows? And we've seen lots of these kinds of things happening over, almost repeated cycles. Almost every 7 to 10 years, we see this happening. And we sit there kind of getting dragged along, and some of us will then jump on that bandwagon, usually at a point where that, that cycle is about to peak and burst. And then we get caught, and I see the international, the Bank for International Settlements, which is kind of the Reserve Bank of reserve banks, doing a study saying that they believe 80% of investors in Bitcoin have lost money. 80%. And that tells me that people have jumped on a bandwagon and then that bandwagon's gone over a cliff. And the reality is this cycle keeps repeating itself. And at some point we kind of have to say to ourselves, perhaps I don't understand what's going on, and that's actually okay. It's okay that I don't understand the crypto space as well as Simon Dingle. He's a really bright man. He's a specialist in his field, and that's great. If I don't understand it, I don't need to invest in it,
completely. And I think you're absolutely right. I want to come back to you in just a moment, but because when we see these trends developing and we start seeing people suddenly, Fred, and I really hope you don't have a neighbor called Fred, because if you do, he's going to be knocking on the door saying, "You said I'm what?" And when you look at everybody else and the sense of FOMO, so you start feeling stupid, and rather than trusting your gut, trusting your instinct, trusting your knowledge, you start acting counter to your normal sensibilities, because maybe this time it is different. I don't want to miss out. I don't want to be the kippy who is sitting 20 years from now. My kids are saying to me, "So why didn't you? Why didn't you invest like everybody else did? Look how rich they got, and you stayed in the old-fashioned world, and look, you're an idiot." And there's a real fear of that sort of thing. So let's pick up on that theme in just a moment. Warren Ingram at Galileo Capital is an executive director. He's a personal financial advisor. He's going to extrapolate a little on those themes for you in a moment.
The Money Show.
Personal Finance with Warren Ingram.
The world of investments is littered with all kinds of things, and one of the most self-destructive and dangerous things in the world of investing is the fear of FOMO, that idea that somebody else is smarter than you, somebody else is getting something you're not, and if you're not going to get it, well, you're going to regret it for the rest of your life. And so off you go and you follow the crowd. You start doing what everybody else is doing, and for a while you may feel like something of a genius. For a while you may even look slightly clever. But the trouble is, Warren, these things are massively volatile. There's a huge amount of uncertainty, and unless you start to really begin to study and understand and absorb and live your investments, you do run the risk of going from FOMO to "I wish I'd never bothered." And there's a real risk there of regret coming later on.
Exactly right. And I think, just being confident enough to say, "Look, I don't know, I don't understand. Either I'm going to go and do the homework and become more of an expert in this, or I'm going to miss this ride," and it's very, very hard to regret a missed profit versus real losses, and I think that's the key in this, is understanding if something goes up, 80% in a year, and it does it for 2 or 3 years. I mean, that I understand that's hugely attractive. The sense of missing out is really compelling. But if it goes up that quickly, it certainly can go down as quickly, if not more. And that's what we're watching now. We're watching an implosion of something which is, potentially was valued at $50 billion going down to $900 million. And who knows, if that's the bottom. Those are huge numbers. And I think to understand, if something's going up that fast, it might well be a fiction. And actually, everyone jumping on the bandwagon, out of every 100 people, maybe one actually understood what was going on. The other 99 were too embarrassed, too ignorant, too greedy to say, "Gee, I actually don't really know what's going on. I'm just following." And that's the point. You cannot be a lemming, running off the cliff here. You've got to say to yourself, "It's my money. I protect it. I'm not going to be the lemming."
Okay, good point. Thank you, Warren, on that one. Little email from Maria this evening saying, "I have an offshore portfolio that I manage. I'm interested in the market and world of investments. How can I be certain that the ETFs I buy are in a tax-friendly jurisdiction so that I don't have to worry about this nasty thing," my words, of double taxation?
Yeah, it's a great question, and I think it's catching a lot of people out. So just understand, investments that are listed in a place like the US or in the UK and many other jurisdictions, that they might end up charging you with dividends withholdings tax or death duties, when you die. So it could just kind of catch you blindsided. So the thing to look for there in the world of exchange traded funds is look for funds that are listed in a place like Ireland, for example. So your first key there is next to their name. If you're searching for these, type in UCITS. It's a categorization of funds. And that tells you that it's already in the European zone. And then what you want to do is look for ones that are specifically listed, as I say, in a place like Ireland, because Ireland, they're not going to tax a non-resident on any kind of taxes when they invest there. And Ireland seems to be the place where a lot of big ETF providers are listing their global funds for investors and making it as easy as possible for global investors to grow their money without being caught in double taxation. And the important point there, Maria, is you're right. It's double taxation. So you're still going to pay tax in South Africa. It's not like you're avoiding taxes illegally. You're just avoiding having to pay twice, which is no obligation that anyone has to fulfill.
Thank you, Warren, for that. I think that's incredibly valuable as always. Warren Ingram from Galileo Capital on The Money Show this evening with your questions on personal finance. Keep them coming through. You can either email them directly to me, or if you think of something smart, wise and insightful during the show, just drop us a WhatsApp. Don't do it afterwards if you don't mind. Rather wait for the next day to make sure that our team gets hold of your questions so that we can put your questions to Warren, who's more than happy to give you a view, and if he doesn't know the answer immediately, certainly very happy to go off and do the research and do the thinking and doing the hard yards on it to make sure that you make better investment decisions. That's what we're here to help you with.